Most people lose money in the stock market, often in the first year. Not because they're lazy, not because they're stupid, but because nobody explains what actually matters before real money is involved. So in the next few minutes, I'm going to give you a simple framework you can actually use. Not something you memorize, not something you copy from someone else, but a way to think clearly when the market feels confusing. This isn't about quick wins or secret strategies. It's about understanding how decisions compound over time, especially during the moments when markets don't behave the way you expect. No stock tips, no hype. Just how real investors think. If you're new to investing, you're usually told two things. 1. Find the right stock. 2. Follow the smartest people. Then you open your phone after work or on the weekend, and suddenly it's chaos. Hot takes, breaking news, buy now, sell now. Recession, soft landing, rate cuts, prices move, headlines change, opinions conflict, and the more information you consume, the harder it becomes to tell what actually matters. Without a framework, people don't pause to think, they react. Most beginners don't lose because they picked a bad company. They lose because they buy when they feel safe and panic when they feel pressure. They confuse confidence with clarity and movement with progress. Being busy feels productive. Being calm feels uncomfortable. They overtrade, they chase, and eventually they abandon a plan they never truly had. Over time, I realized long-term investing isn't complicated. It doesn't require secret formulas or constant predictions. But it is uncomfortable because the market is designed to test your patience, and it comes down to three fundamentals most people ignore at the beginning: risk, time, and behavior. First, stop trying to predict the market. Beginners obsess over timing, top or bottom, this week or next month. They believe that once timing is solved, risk disappears. That's the illusion. Prediction creates confidence. Confidence leads to larger positions, and larger positions magnify emotional mistakes. Markets don't reward prediction, they reward preparation. Preparation means deciding your roles when you're calm, not when you're stressed or reacting to headlines. It means knowing how much uncertainty you can tolerate, and what kind of volatility actually makes you uncomfortable. You define what you'll buy, how much you'll buy, and what would genuinely make you change your mind. You're not preparing for when things go right, you're preparing for when they don't. Because that's when most people abandon their plan, and you accept a hard truth: you will never buy the exact bottom, and you will never sell the exact top. Trying to be perfect leads to hesitation. Being prepared leads to consistent action. Second, risk is almost always misunderstood. When markets are calm, people confuse calm with safety. But calm markets hide risk. They don't remove it. Real investors think about downside first, not because they're pessimistic, but because they want to survive long enough to be right. Ask yourself this: what happens if you're wrong longer than you expect? Not one bad day, not one bad week, 6 months, a year. Risk management isn't exciting, but it prevents one emotional decision from undoing years of discipline. Survival matters more than speed. The hardest lesson to accept is that boring works. Exciting strategies demand constant attention. Constant attention creates emotional fatigue, and emotional fatigue leads to mistakes. Long-term results come from boring actions repeated consistently. Intensity is emotional. Consistency is structural. If your strategy requires perfect timing, daily monitoring, and emotional energy every single week, it's probably not sustainable. Because real life gets in the way. You get busy, you get tired, you lose focus, and a strategy that only works when you're at your best will fail when you're not. Small, repeatable decisions matter more than dramatic moves, especially over long periods of time. Boring strategies survive because people can actually stick to them. I've seen intelligent people blow up accounts because they couldn't control emotions. They knew the theory, they understood the math, but emotions overruled discipline. And I've seen average people slowly build wealth simply by staying disciplined. The difference wasn't information. It wasn't intelligence. It was behavior repeated, consistent behavior over time. That's why the market feels hard. It punishes impulse and rewards patience. If you're just starting, comment "Start" below. If you've already learned some of these lessons the hard way, comment "Learned." Reading those comments helps this channel understand who it's actually helping, and it reminds people they're not figuring this out alone. Before you place your next trade, try this quick checklist. 1. Write down your time horizon: weeks, years, or decades. If you can't clearly define the time frame, you're probably reacting, not planning. 2. Define your risk in plain English. If this drops 20%, will I still sleep at night? If the answer is no, the position is already too big. 3. Decide your next action in advance. If the market drops, will you buy a little, hold, or step back? Making that decision now prevents emotional decisions later. Don't wait for fear to decide for you. Fear always chooses the worst possible moment. And 4. Limit decisions. The more often you check prices, the more your emotions get a vote. You don't need more information. You need fewer, better decisions. A simple plan you can follow beats a complex plan you abandon. If this kind of calm, practical approach is what you've been looking for, consider subscribing. All content is for educational purposes only.